This is the Rational Reminder Podcast, a weekly reality check on sensible investing and financial decision-making for Canadians. We are hosted by me, Benjamin Felix, and Cameron Passmore. So something that we have been really bad at and are going to get better at is using our rationalreminder.ca website, which is a website that's been up for a while, but we're going to get better about posting the episodes there. And one of the main motivations for us to do that is that, as some of you probably know, because you're probably listening on the platform, our episodes automatically get posted on YouTube when we post them, and that's great. And there's about 100 people that listen on that platform. But the really cool thing about YouTube is that you can comment. On iTunes, you can't comment. And so we get, even though it's a relatively small subset of our listeners that are listening on YouTube, we get great comments and great questions and great interaction.
But you get great to get the comments over on the Rational Reminder site.
Right. Every time we post an episode, it goes up on the rationalreminder.ca website. And you can click on the post and you can comment down at the bottom when you scroll down. So it's got notes about the show, and we're going to start putting the links to the content that we talk about up there. But you're also going to be able to comment. And so we're hoping that some people will go to the rationalreminder.ca website, and if they have something to say or a question to ask about an episode, that they will do it there. And as great as it is when people send emails, if you comment on a post, that's way cooler because then other people can see it too, and they can see the discussion and the follow-up. So I guess that's our request. If you have something to say or something to ask, if you can do it on the rationalreminder.ca website on the episode that you're talking about, that would be awesome.
Yeah, look forward to that for sure, because the chat that happens on your YouTube channel, for example, is really interesting. There's a lot of good engagement and discussion there.
And I take away a lot from that too. Like I learn how people are thinking about things.
So today's podcast, a lot of cool topics, mainly on real estate, mortgage rates, REITs.
I love the discussion on REITs.
Yeah.
It's a factor discussion.
Yes, it is. And it's a good factor discussion with good takeaways.
That's it. We'll go to the episode. Welcome to episode 58 of the Rational Reminder Podcast.
Yes. And before we jump into the normal items that we do every other week, I just noticed walking into the room today that Berkshire Hathaway, and this gets back to our discussion a couple of weeks ago about reliability, Berkshire Hathaway stocks, so Class A shares, have underperformed the S&P 500 index year to date by 18%. Not that it's a bad stock, but it's unbelievable. But it shows you when you concentrate on something, how you may not end up with as reliable an outcome, which has been, I know, one of your perpetual points you're always making. It's all about reliability and using the evidence to have a more reliable outcome, as opposed to having something with high tracking errors, so trying to hit it out of the park.
Yeah, I mean, it'll be really amazing to see how Berkshire does over the next 10 or so years. I mean, Buffett's aging, obviously.
He's 89, I believe.
Well, he's still at the helm. It'll be very interesting to see from a data perspective. It'll be interesting to see what happens with that security.
They have $114 billion of cash, and they're picking up $25 billion a year of free cash.
Yeah. Well, we're going to see. I mean, that's why I say in the next 10 years or so, it's going to be pretty obvious. Well, maybe it's not going to be obvious. That's not fair to say, but we're going to be able to observe the skill that's gone into the past returns, because as of today, Berkshire's trailed the S&P by a decent chunk, like over 1% annualized for more than 10 years now. And so is value stocks. So have value stocks. So it's not fair to just lump Buffett in and say it's his fault, obviously.
No, that's not the point. The point is about reliability and how much of the return can come from such a small part of the market.
That's exactly. But say value comes back, how much does Berkshire come back? Does Berkshire beat the S&P if value comes back? That's what I want to see.
It will be interesting.
All right. Well, that was our
pre-current topic, but the current topic is about mortgage rates and something that's happened recently where the fixed rate for mortgages is now lower than the variable rate, which has not happened, I believe, since the early 90s.
Yeah.
I mean, it's been a consistent theme through my entire career that you'd be smart to go variable all the way along. Rates rise, rates drop, it would have been better for you. Of course, you've had a falling interest rate environment for the past 25 years, so that's obvious in hindsight. But the whole thing has completely changed now. At
this moment, yeah. And it all relates back to the Canadian yield curve, I guess, is inverted at the moment, meaning that short-term rates are higher than long-term rates, which isn't normal. Normally, you'd expect to have higher yields on longer-term fixed income because you're taking more risk by holding longer bonds. That's an upward sloping yield curve. That's a normal yield curve. But at the moment, it's inverted.
Yeah, and the variable rate is linked to prime, right? So right now, prime is 3.95 in Canada, and the 5-year variable rate, when I just did a quick search, is around 2.9%.
That's right.
But you get a 5-year fix right now at 2.69 is what I saw.
Yeah. I mean, it changes the whole conversation for the moment about fixed versus variable mortgages.
Yeah. Now we know you're a renter, and we'll talk more about that after. But if you were a buyer, what would you do now?
Yeah, it's tough to say. It's pretty compelling to go with a fixed rate mortgage when it's lower than variable and it's fixed. You're not at risk of interest rates rising and affecting the rate on your mortgage.
Yeah, and assuming you're committed to being in that house for a long period of time, I think it makes a lot of sense. I'd be in the fixed camp for sure.
Yeah.
That's a great rate.
Yeah, it's a low rate. It is an interesting, broader discussion just about the yield curve in Canada. I mean, we talked in our last episode where it was just the two of us about bond returns and global bond returns have been great. Canadian bond returns have been great as well. And a lot of that relates back to what we're talking about with the mortgage rates, because it all has to do with the yield curve. The yield curve flattens, longer bonds. If the yield on bonds drops, it means the price on bonds went up.
Which has happened in portfolios so far this year. We've got remarkable returns in fixed income.
Yeah, you just look at the Vanguard bond index funds for Canada, and they're like 7% returns this year. But it's all got to do with the shape of the yield curve. And that ties back again to the GIC discussion that we had a couple of weeks ago, where that term structure affects your returns. If the term structure changes, you can have really great fixed income returns, and you don't get to participate in that with the GICs. You don't get that exposure to the term premium. But people always say, like, well, interest rates go up. That means bond returns have to be bad. This year, we've had rising rates and high fixed income returns. But it's because of the change in the shape of the yield curve. Yes, interest rates went up, and that people are like, well, that must mean negative bond returns. Interest rates went up, but the shape of the yield curve changed as well.
It depends on the duration of the bonds and if the duration matched up to where the interest rates are falling.
But it's just like with stocks. You maintain exposure to term and credit, and you'll be in pretty good shape.
Exactly. Which leads us perfectly into current topic number 2. And this was an incredible article that you found from the Visual Capitalist that looked at Canadian real estate and looked at the prices relative to rents, relative to incomes, and relative to inflation. I was absolutely stunned by this infographic.
So there's one that I've been referring back to for years now that was from The Economist, but it ended in 2016. And this one went from 2015 to now. So I was pretty excited to see it because I hadn't seen updated data since that Economist chart. But so in Canada, prices have almost doubled relative to rents from 2015 to now. 195.9.
So what is that scaled on? Do you know? Or it's just a relative?
Well, it's prices relative to rents.
So prices have climbed way faster than rents have. Therefore, affordability of rent is increasing.
Relatively.
And we're one of the highest in the world, right? Just behind, I think, New Zealand on that one.
Yes. I looked at a bunch of countries. I didn't record how many countries they looked at, but New Zealand is the only country that was ahead of us. So their prices relative to rents have grown at 196.8x. And it is actually an interesting little quick digression to talk about with New Zealand, because you look at real estate prices in Canada, New Zealand, Australia, and other developed countries, but those are kind of the hottest real estate markets. And they've just had these crazy returns for quite a while now. And we've seen Canada do a few things to try and cool that off, and maybe they're working, I don't know. But New Zealand has completely closed off their real estate market if you're not a citizen or resident. Shut it down.
So you cannot buy it as a rental. No foreign money can go into New Zealand real estate.
There are ways that you can invest in properties. I don't think you can invest in a detached home, and you can't buy a vacation home. Like, you have to be a resident in order to purchase a house. If you're an investor and you're going in to build an apartment building that's going to create more housing, then there are a process that you can go through. But if you're just a guy that wants to buy a house, you can't do it. Like we hear, and I know this is maybe controversial, but all the stories about the Chinese money coming into Vancouver to buy all those houses in New Zealand, it can't happen. Another interesting data point that I pulled out of there just on the prices versus rents was that Portugal, their prices have been increasing like crazy, but their rents have also been increasing like crazy. So their prices relative to rents, that multiple is nothing like Canada.
You think it's rent control in Canada that keeps the lag there? It must be. Because the only way to go around that, I believe, is to...
rent evictions?
Yes.
Yeah, it very, very well could be. It very well could be.
Because I know of people in Toronto that can't afford to move because their rents are so low relative to what the market value is. And they've been there for so long.
And it depends on the market too. That's why when we talk about that rent versus buy decision, I love that 5% rule idea. Yep. Because then regardless of what prices and rents are in your area, you can just take 5% of the value of a property. And if you can rent for less than that, then renting's probably a pretty good idea.
Some other data points you had here. So Canadian house prices have increased 155x relative to incomes since 2015.
Crazy.
And house prices have increased 124x relative to inflation since 2015.
Relative to incomes is a scary one, right? Because you start thinking about the sustainability of the prices. And if people are buying these houses as investments, to rent them out to get a reasonable return, because you got to keep in mind, like, and this is an interesting thing that I would love someone to study. My hypothesis is that landlords, property investors, and I don't know if this is specific to Canada or not, but property investors overestimate the capital return that they're going to get from real estate, which means that they're willing to take a loss.
Oh, absolutely. I mean, we hear that anecdotally all the time.
Right.
And no one does, as we said many times, the proper accounting of what it costs to actually operate a home.
Yeah, I mean, if you look at the historical data, we've talked before, I think, about how real estate returns as an asset class, like direct investment in residential real estate, has, throughout the course of recorded history, outperformed stocks by a bit, but with less volatility. Great. But that comes from mostly net rental yield. Like the historical net rental yield globally has been 5%,
right.
Roughly 5%. And the capital return globally has been about 1% in excess of inflation. So if you're not getting that 5% net rental yield, your expected return on a real estate asset is, if you're taking a loss on the yield, it's maybe less than inflation. But people are willing to accept rent that is low or making them break even or whatever you want to call it, because they have these high expectations for the future capital returns. Because we've seen that in Canada and other developed countries.
Well, it's not been my experience owning a home. As someone who just put in, I don't know, $750 last week just to redo the parging on the house, which is like...
Well, you should have bought in Toronto.
It doesn't change. Well, I know I should have. Come on. Anyways, some other neat data points here. And this we live all the time with clients with kids. So this comes out of Financial Planning Canada. They did a survey with Leger. They interviewed just over 1,500 Canadians just in April of this year. And they found that, get this, 48% of parents with kids under the age of 18 plan to help the child buy their first home. And 24% of parents with kids over the age of 18 have already done that.
That's crazy. You heard the comment I just made about if people are buying these super expensive houses. I actually don't think I finished that thought. People are buying these expensive houses. They've got to rent them out to earn the net rental yield to make their return reasonable, but they can't, because if incomes don't keep up with what you would need to charge in rent to get a reasonable return on your real estate investment, that shows that incomes aren't keeping up with what you would have with the rents you'd have to pay. But that means that the price of the real estate assets is not sustainable. What's going to sustain the price? If people can't rent them, then people won't invest.
Okay, so now fold in this data point. 4 in 10 say they expect that helping their children to buy a home will postpone their retirement.
Man, that's scary.
But again, we hear this all the time. Run the plans and plan on giving the child X dollars at a certain point in the future. What does that do to the success rate of my financial plan? Very common.
Yeah, it's scary stuff. We'll see what happens, I guess. There was another study on this topic. There's a bunch of stuff. I guess I went down a real estate rabbit hole. So the Canadian Centre for Policy Alternatives released a study in July. It was like recently, and it's called Unaccommodating. They created a metric, the average rental wage. I think that's what they called it. So they figured out what is the wage that you would need to be earning in order to rent in various Canadian cities, such that your housing cost would not be more than 30% of your income. And they called that metric the rental wage.
This is a single person or a couple?
I believe it was a single person renting a 2-bedroom. So they found that, so average across Canada is $22.4 an hour, which is obviously way more than minimum wage.
$7 over minimum wage, I guess.
Okay.
More or less.
That's what it is. Okay.
But look at the rates for different cities.
Yeah. Vancouver, $35 an hour you'd have to be making to meet that criteria. So to rent a 2-bedroom without spending more than 30% of your income in Vancouver, you're making $35 an hour. Toronto, it's $33 an hour. Victoria, BC, $28 an hour. And Ottawa was on the list of the top most expensive, $26. But anecdotally, a lot of people are talking about how expensive rent is. I mean, I'm living it, I guess. Rent's not cheap.
It's not cheap. And we had a colleague here help a friend, and I guess it's super tight supply. She was out this past weekend and very hard to find anything.
Yeah, vacancy in Ottawa is extremely low for whatever reason, tight rental market. But I thought that was fascinating. I thought it was fascinating just the numbers in general, but the fact that Ottawa is on that list of the highest rental wages. From an economic perspective, this report went into some really interesting detail. They talked about how between 1996 and 2006 in Canada, we had this combination of rising wages, falling interest rates, and modest house prices. So those three things resulted in a lot more people buying real estate, which in return caused these price increases that we've seen.
Which completely went against the whole boomer story, which is as the boomers age, they're not going to want the big houses in suburbia, so they'll be dumping them. So I can remember being told, you got to get rid of the big house because the crash is coming. Yeah, not exactly. But I also remember going back to 1989 when friends of mine bought places in Toronto and they just got killed for a long time after owning, he owned a townhome, I think it was in Scarborough, and just got demoed by an 89.
Well, there's a great chart that this a real estate agent in Toronto, she seems to be updating it every year or so, but it shows Toronto real estate prices from the peak in 1989, because there was a little recession that followed that. But if you bought in 1989 in inflation-adjusted terms, you didn't recover the value of the property, or you couldn't sell for what you bought it for in real terms until 2010. 1989 to 2010 in Toronto. So we see the current run up in price. And if you look at that chart actually, and I'm not everyone knows I don't believe in market timing or technical analysis or anything, but you look at that chart and it's peak, crash. And right now, where we are, 2019, peak. Well, I don't know if it's a peak yet, I guess.
You don't know.
Because I can't see the future, but it's high. We'll leave it at high. Just on that concept of real estate prices being flat in real terms in Toronto from 1989 to 2010, I started thinking about, for myself, like we rent a house now, it's a great house, we're in a 3-year lease, we're not going anywhere anytime soon, but am I going to buy after that? And maybe, who knows, right? But you start thinking about from a financial perspective, to get the expected return on an asset, you've got to hold it for a long period of time, just like that data point about Toronto real estate shows. If we buy a house 3 years from now, then my oldest son's going to be 8. And then maybe I've got 10 or 11 years before kids start leaving the house. So if we bought a house to accommodate our family now, it's going to be too big, presumably, within 10, 15, whatever. So
unless you want the big house for him to come back with.
I guess so.
His future. I mean, a lot of people keep the big house through the kids and grandkids.
That's true. It just feels like it'd have a lot of dead real estate asset.
But you're also extremely rational.
Well, such a big cost of, imagine you have a paid for house or a mostly paid for house that's way too big for you. Imagine the cost of equity is huge. I think that changing life circumstances affect the time horizon for owning real estate. And we see this, people change houses often, more often than they should from a financial perspective. And I think that puts a time horizon constraint on real estate purchases, which makes the price risk way more real than most people realize.
Okay, so let's roll over to REITs. This is on the commercial side of real estate as opposed to personal home ownership. And in Canada, I'm sure many of our listeners go to a REIT every single week when they do their groceries. So places like RioCan Malls, H&R, the Smart Centers, Choice Properties, which I believe is the Loblaw spinoff. I'm sure both of us go to at least one REIT every single week.
Yeah. They're residential REITs too, like CLV Group. I don't remember what their REIT's called. But anyway, their buildings are all over Ottawa.
But it's a great way to get exposure to an asset class where in one trade, you can own a bunch of underlying malls or apartment buildings or retirement homes.
And the nice thing about it is you get exposure to a generally illiquid asset class. Like if you go and buy a house or an apartment building, that's not liquid. Plus it trades in huge transaction sizes. But you can access, just like an index fund, you get a diversified portfolio of real estate assets, but it's also liquid, daily pricing, diversified, all that good stuff.
I can remember when they all came public, or a bunch of them came public 15, 20 years ago, and they all had yields of 10, 12, 14%.
Wow.
Yeah, it was crazy. And they were all IPOs, right?
Yeah. So you look at market cap of REITs, so publicly traded REITs, is a 3 to 5% globally, depending on which country you're looking at. Anytime you own an index fund, like if you own a total market index fund, you own REITs in the market cap weight, whatever it is in the country that you're looking at. But the reason we're talking about REITs for our portfolio section today is that a lot of people will overweight REITs. So they'll say, okay, I understand there are REITs in my portfolio, but I want to have more than market cap weights.
Largely because you're guessing they like the cash flow?
Could be cash flow, a preference for cash flow, but it could also just be the historical returns. REITs have had really good returns. Pulled the data for S&P Global REIT Index from 1989 through June 2019, and it returned 9.24% per year on average.
So that's 30 years.
While the MSCI All Country World Index over the same time period returned 7.77% per year on average, both in Canadian dollars. So better returns. But not only that, they were imperfectly correlated. The correlation was 0.5. So, seems pretty good, right? Like, why would you not want to overweight that? So sure, they've had good returns, but where did those returns come from? And the real question, when you get down to the root of it, is, are REITs a separate asset class? Because if they're a truly unique asset class that are adding truly unique risks to the portfolio, then sure, makes sense to overweight them. Just like we talk about overweighting small cap and value. If it's a truly independent source of risk, then yeah, of course you would overweight. But there are a couple of papers on this. The papers are fascinating. So there's a 2018 paper titled Real Estate Betas and the Implications for Asset Allocation by a guy named Peter Mladina. And he looked at this. How distinct are the returns of REITs from the returns of stocks and bonds? And he used a custom 5-factor model that he built for this purpose. And the factors he used were market beta, size, value. So those are equity factors that we're all familiar with. Yep. But he also used term and default. So he combined equity and fixed income factors together into the factor model. And he looked at the period from 1986 to December 2015.
So most of the period you mentioned, those returns up above.
Yeah, that's a good point. You're right. Now, here's where it gets interesting, is that the returns of the REITs over that time period resembled the returns of a 60% small value, 40% high yield bond portfolio.
Isn't that amazing?
It is amazing.
There's always an explanation for returns.
Right. So the risk exposure of REITs is effectively the same as holding 60% small value, 40% high yield bonds.
Intuitively, that makes a lot of sense.
Yes, I mean, it's a hybrid asset class.
And there's smaller cap than large caps for sure, and they do have a lot of yield.
Yeah. So Mladina found the factors that explain the returns of real estate are priced risks that we know. So the size, value, term, default, all that stuff. Those are all priced risks. So we can explain the returns of the REIT asset class with these priced risks. So that's a good thing. Risk that you want to be taking because you're getting a positive expected return.
But they are not a unique source of return.
They're not unique. You can get those same risks through stocks and bonds. So here's where it gets really, really interesting is you're getting exposure to those risk factors through those priced risk factors. But the risk of REITs, so we can explain the returns with stock and bond factors, but the risk of REITs is primarily explained by the specific idiosyncratic risk of the real estate sector. Boom, mind blown. So you're getting exposure to these equity and fixed income factors that are priced risks. Good, check mark. But the risk of the REITs is dominated by the specific risk of the real estate sector, which is not a priced risk.
So you're not getting compensated for the idiosyncratic risk of individual REITs when you could have bought a much more diversified small cap value portfolio with high yield bonds. So same expected return, much lower idiosyncratic risk, so lower volatility.
Lower volatility, and you're getting compensated for the risk that you're taking.
And eliminating the risk that you're not taking, so it gives you a more reliable outcome.
Correct. Yeah, very nice. Back to reliability. So Mladina did this paper, and then Jared Kaiser and Sean Grover, who are with Buckingham Strategic Wealth, they did a paper in 2017 called Are REITs a Distinct Asset Class? And so they did the same kind of regression, and their numbers were a bit different. They found 67% small value stocks and 33% corporate bonds. But then they did something that Mladina didn't do, is they actually built a model portfolio of stocks and bonds that they designed, in hindsight, to match the factor exposure of REITs. And that was the 67% small value, 33% corporate bonds. And as you would expect, based on what we just talked about from the Mladina paper, they were able to get better returns, better risk-adjusted returns with the small cap value and corporate bond mix portfolio. That was better than REITs, which that is consistent with the idea that you're going to get the same factor exposure, but REITs have all this extra non-priced, non-compensated risk.
It's still amazing though, because you would think the small cap value would have very high volatility. So it must be the diversification with the fixed income and the rebalancing that really dampens that volatility.
Well, REITs are volatile too, though. Can't forget that.
Yeah, but we've gone through an era where rates have fallen, so you would think that would be helping the price appreciation of the REITs. Rates have fallen, not REITs.
Well, but you think about the real estate crash in the U.S., that's not going to help the REIT
that's true.
data.
That's true. Yeah, it's super fascinating data.
Yeah. And so in the way that Dimensional thinks about this is that they actually exclude completely REITs from equity portfolios. So I mentioned earlier that if you buy a market cap weighted ETF, REITs are in there at market cap weight. Yep. Dimensional strips them out completely and builds a portfolio of stocks based on the factors of higher expected returns, and then just adds REITs in sort of a market cap weighted diversified index portfolio as a separate component.
Yeah, on a market cap basis.
Correct. And they do that because the same weighting towards small cap and value and all that kind of stuff doesn't work the same way for REITs. So they just strip it out. And in the portfolios that we're using, they're just held in market cap weights. So I think the conclusion for that discussion is that if you want to overweight REITs to get exposure to those risks that are present in REITs, the priced risks, the best way to do that is to seek exposure to small value and high yield or corporate bonds.
So this is just a rational reminder to consider that as an alternative as opposed to investing directly in REITs.
Right. And if you invest in REITs, maybe you'll get a great outcome, but maybe you won't. But you are taking a lot of risk that you're not going to be compensated for. That's kind of the catch with REITs.
So the planning topic this week, so there's a great article that's been retweeted. I can't even imagine how many times, but I know it's been in my Twitter feed a lot this week in the New York Times from Jeff Sommer discussing the Dalbar report, which is a report that's been coming out forever, talking about how well investors do compared to the investments they're in. Do they do as well on their own in the investment compared to the actual investment themselves? And it's always coming out with the same story that investors' behavior causes them to way underperform the actual investment they are in.
And there are all sorts of criticisms of the Dalbar report, but I think the message is generally probably fine. I don't know if the magnitude of the data that they talk about is necessarily correct.
Yeah, we could do that another podcast, it'd be kind of cool to dig into the criticisms of it. But it's a huge margin. Like the one that they found was 5.88% annualized.
Equity investors trailed the S&P 500 by 5.88% annualized over 30 years.
For 30 years. And that's a massive amount of cost of behavior.
But I think one of the most sensible criticisms of the Delbar is that we don't know why people are moving their money around. People could just be naively bad investors, but it's not because they're freaking out when the market's down. It's because they needed to pay for their kids' education, or they decided to pay off their mortgage as opposed to leaving their money invested, and it just happened to be at the wrong time. I don't think that the Delbar report corrects for that.
But the thing that blew both of us away, and here's the quote.
This is amazing.
Amazing. So compare the returns of investors in variable annuities to the investment of the variable annuity.
Do we have I don't think we have variable annuities like that in Canada.
I think it's kind of the guaranteed minimum withdrawal benefit type investment.
Okay.
So it's insurance products with high fees and high loads. I think. I know a lot of very large investment firms in the US absolutely hate variable annuities. So this is not a commentary on variable annuities at all. It's quite the opposite, actually. The performance of investors in variable annuity funds, which are higher fee, lock-ins, redemption fees and whatnot.
Actively managed, probably, like ugly stuff.
Ugly stuff with high commissions. Here's the quote. Despite the extra fees and penalties, perversely it seems because of them, investors in variable annuities outperformed those in mutual funds over 12 months, as well as over 3, 5, 10, 15, and 19 years.
That is fascinating.
So you throw handcuffs on people and it ends up they behave better.
You'd love to see that data on DSC mutual funds. I don't know if that's ever been done.
I have no idea. DSC being deferred sales charge, so the funds that lock you in for 5 or 7 years and charge you if you leave in that period, which I think is not used very much anymore. But it's amazing how behavior is everything. Behavior is the story.
That point, I mean, who knows how reliable this data is, and I don't know what went on behind the scenes to calculate those numbers, but assuming the relationship is at least reliable, that variable annuity investors outperform mutual fund investors with the higher fees and all that stuff, that is a huge testament to the importance of discipline, which I think people often discount.
Well, look at our day-to-day. Often we hear things like the market's frothy and I'm just going to sit in the sidelines and I don't care if I miss some of the return. Look at the returns so far this year. They're staggering. It wouldn't have been hard to convince people in December to sit on the sidelines. December was ugly. And you missed one of the best 6 months we've had in ages. Jonathan Clements, who was on the podcast 3 weeks ago, I guess, put out another article last week talking about the 15 most important notions that are important to making our lives better. And number one on that list was humility. So I think when it comes to portfolio management, his point is you need some humility and not try to time the markets and get fancy. Just stick to your strategy and focus on the long term. So bad advice of the week. Yeah, there's an article I just saw in Institutional Investor. I don't know if you got a chance to read it or not. So the title of the article was, There is no better time to be an active manager. And the thesis of the person that was interviewed is that in a market dominated by passive funds and other quant strategies, there's a way to create opportunity for actively managed funds. Here's the quote. There is no better time than now. And even more dramatic in the value space, says Warren Coons, who's the head of value equity at Jennison Associates. And this is no small shop. They manage $176 billion for PGIM, it's called, which is a very large insurance company in the US that manages over $1 trillion. This is a huge operation. And they were recently interviewed on Barry Ritholtz's podcast, a month or so ago. But I just found it interesting how there's an article that says there's no better time to be an active manager, but there's absolutely no data in this. So he's watching fund flows in and out of a variety of different ETFs and said that's giving him signals of when to trade. So he says, if you're someone like me who is a value manager focusing on the intrinsic value of companies, and you have a top-down force that's driving a whole group of stocks out of favor, it creates wonderful opportunities to invest. Great story, but where's the data?
There isn't any.
There isn't any, but it's kind of a throwaway article. But as long as there's people like that, that's kind of the point, right? People often ask, what if the whole world index or everyone's indexing, there's no one left to do the fundamental research? I just don't see it happening. There's so many people like this. We have a long way to go before we have to worry.
So many people like that, but the trading, even with indexing at 50% in the US, the trading is still done 95% of it by the active managers. So it's they're decreasing in assets, but their ability to set prices is not dependent on the magnitude of the assets that they manage.
Correct, because you might have 40% that are indexed, but its trading volume is very low. So it's all about price discovery on the trades.
And then it comes back to who's competing with who. If there are just a couple of active managers left, or if they're both really, really skilled, then they're still going to be able to make the market efficient. Just those last two of them battling it out. And even those two, even though they're both skilled, you have that whole paradox of skill where two skilled active managers, as skilled as they are, if they're both as skilled as each other, the winner of each trade is going to be based on luck if they're equally skilled.
The takeaway, I think, for listeners is you see an article like that, look for a little bit of data that's at least somewhat scientific. There's not a scintilla of data in this article. It's a belief, and that's fine. But as an investor making decisions on your portfolio, be critical of it.
Yeah. That's the whole behavior piece. It's really not easy. There's so much information out there, and so much of it is even directly attacking indexing, saying why it's bad and why it's going to break the market and why you shouldn't be doing it and all that kind of stuff. But it's like, man, where's the data to back any of that up?
Yeah, this was not an attack. It's basically saying because of what's happening, the passive side, I can capitalize on that.
That's still an attack, though. It's saying that you shouldn't index. You should do what I'm doing because look at all the opportunities all those silly indexers are creating. But like you said, show me the data. Prove it.